Hello, everyone. Welcome back to the Lytham Spotlight Series. My name is Robert Bloom, managing partner here at Lytham and your host. For today's episode, we're mixing things up a bit, and instead of shining a light on another public company, we have a very special guest here to discuss the state of the small and microcap landscape. That special guest is none other than Joe Lucosky, managing partner at Lucosky Brookman. Lucosky Brookman is a corporate and securities law firm directly serving the microcap and small cap markets, specializing in corporate and capital markets transactions, mergers and acquisitions, secured and unsecured lending deals, and commercial and securities litigation. We're very excited to have Joe here with us today as he brings a wealth of knowledge in navigating the financial market landscape. And joining him moderating this discussion is our very own Lytham Vice President, Ben Shamsian. Before I pass it over to Ben and Joe, I want to remind everyone, if you haven't done so already, to hit that subscribe button so you don't miss out on any future content. And if you find today's episode insightful, hit that like button as well to let us know. All right, without further ado, Ben, take it away.
Thank you, Robert, for that introduction. I'm excited to be moderating today's spotlight featuring Lucosky Brookman, and I hope you all enjoy what's sure to be a meaningful discussion. Without further ado, let's get started. Joe, welcome.
Hey, Ben, thank you for having me.
Let's get into it. I believe Lucosky Brookman is the only law firm in the country, probably in the world, that tracks all the uplists, the cross lists, the IPOs, even in the microcap space. Can you tell us a bit more about your data-driven approach and the value that it brings to your clients?
Yeah, sure. Thank you for asking this question because it is a really, really important one. And I think it's one that separates us from the industry. We noticed a few years ago, actually back in 2020, that a lot of deals relied on individual experiences and opinions of the individual participants in the deals. And we just thought that there had to be a better way to figure out what was right, what was wrong, what was needed, what was unnecessary in transactions. Because as you know, the emerging growth space, the microcap space, is not really readily available with respect to most data. The exchanges don't track deals under $50 million. There's no such thing as a microcap a spreadsheet you can bring up or an emerging growth spreadsheet. So we really took this hard to find data and created the Lucosky Brookman data desk back in 2020. And from there, we were able to segregate all of the emerging growth and microcap data in really three specific areas. Every microcap IPO, every microcap uplist, and every microcap cross list. Those are the deals that we track, and we curate all kinds of different data, from number of deals to offering sizes to investment bankers to other structures, and really try to identify market data and trends that are coming out of the emerging growth space. And it's been wonderful because one other thing that we do is we share it with the community. We share it with the ecosystem. We don't hoard this data. Our data desk spends a lot of time monthly curating this information, and we put it out to the market to not just help our clients make better decisions and internally make better decisions, but hopefully uplift the ecosystem and allow them to use this data to see what's going on, make better decisions, and make the entire community better.
No, that's great. We actually at Lytham Partners use your data quite a lot and refer to it often. So it's been a great asset for us. Maybe you can really dive into the data and what the data looks like for 2024. Can you walk us through the past couple of years in the microcap IPO market? Just the highlights, because in the end, it's all connected. You really need to understand what happened the last couple of years to kind of understand what 2024 has come to. So if you can just give us a little bit of that background from a data standpoint.
Yeah, no, it's such an important question. I always tell people in the community and ecosystem, and when we speak on different panels and different stages, in order to really assess what we're doing today in the marketplace, it's really instructive and helpful to understand where we've come. We've been tracking this data now for almost 5 years. And, when I tell people sort of the themes of what our data desk has uncovered, and the undercurrents for the last 5 years, people seem to understand a little bit more where we currently are. So I'll just quickly go through the last 5 years. 2020, as everyone knows, was the year of COVID. The first 6 months of that year were very treacherous, very fearful, very tight, not a lot of activity. People didn't really know which way the market was going to go or turn. And then something happened in July or August of 2020 where the market started taking this upward trajectory, which really led us into 2021, which, as everyone knows, was the year of the hockey stick. Almost any reasonable deal could get done in 2021. It was fantastic. I'm not sure we're ever going to see another 2021 in the near future, but we're certainly hoping for it. But that really brought us into 2022, which was chugging along quite nicely for about the first quarter or two of 2022. And then something happened in August of 2022. NASDAQ hit the pause button. We refer to this in the industry as the NASDAQ pause. They took a 5 to 6 week period where they shut down every emerging growth type of deal and really reevaluated the type of process they were going to use to ensure these listings could be done in a full, fair, transparent, and compliant way. So we had a 5 or 6 month hiatus at the end of 2022, which really hampered that year and the deals that happened in the fourth quarter. Then we turned to 2023, where deals started to pick up again. But the theme of 2023 was really less is more. Less amount of deals, less offering amount size, less average price. These things just permeated throughout 2023. While the market was still active, the theme, the underlying current was less is more. And then that really brought us into today, where we can look at 2024. And the biggest thing that we see in 2024 is that it tracks 2023, where the current theme still is less is more, but getting better. And we already have surpassed in 2024 the amount of deals, number of deals that we did in the emerging growth space, the microcap space, in all of 2023. I think we're at maybe 94, 95 deals currently through the year versus 87 in 2023. And we still have all of December to go. I think while deal sizes are still down and offering amounts are still down, again, they're inching upward. The microcap, the emerging growth space has raised over $1 billion throughout 2024. So a marked improvement over 2023. And I will just make one other comment. Since the election is now over, we are seeing more enthusiasm, optimism, encouragement, and just a lot of activity coming down the pipeline. So we're very, very optimistic looking towards the future.
Great. So, sort of the big numbers for 2024 look promising. What are other interesting takeaways when you further dig into the numbers?
Right. So there's a lot of trends that we track and a lot of data that we curate and analyze. Some of the more interesting things that I can recall is that the median capital raise for 2024 was about $7 million. That's off a little bit in 2023, where it was around a little bit over $8 million, but still, number of deals is outpacing 2023. The other thing that is a good data point, just for reference, we don't use it a lot, but the average public offering price has come down almost every year from 2020 through 2024. This year it was about $5.13. For NASDAQ and the New York Stock Exchange, that's pretty significant because it was $5, $6, $7 in years past. Again, not a great statistic, but just one that's interesting because it does track the broader emerging growth space. The other thing that we notice, and we've been saying this for many years now, we've kind of called the market on this, that the sweet spot for deals is somewhere between 4 million on the low end and 8 million on the high end, especially in the emerging growth IPO world. So what does that mean? It means that if you have $15 million public float that you need to achieve and the sweet spot for deals is only $4 to $8 million, you got to find other ways to get to that $15 million, either through legacy shareholders, debt conversions, or other sort of structuring techniques. But we have seen that sweet spot still today, $48 million, but again, slowly inching up. The other thing that we noticed, and this is just a phenomenal statistic, is that 71% of the microcap and emerging growth IPOs are from foreign private issuers. 65 of the current 93 deals that we track in our data is from foreign private issuers. That is an amazing statistic because in 2021, the year of the hockey stick, where almost any reasonable deal can get done, that statistic was inverted. It was flipped. It was mostly domestic deals, less foreign private issuers. But as the market has tightened, as it's become more challenged, the market has looked for other variables. And we believe that the foreign companies, especially those coming out of Asia and other parts of the world, may have a more significant balance sheet, maybe a tighter business plan, maybe a quicker approach to net income or break even. And that is what the market is really looking for. So this foreign private issuer phenomenon is really fascinating and it's dominating our emerging growth space. The last thing I'll say is that the other trend that has really continued is the dominance of legacy shareholders, or what we call selling shareholders. Again, we talked a little bit about if the sweet spot is between $4 and $8 million of getting an IPO done, the difference has to be made up to get to $15 million. How do you get there? Well, one of the ways is by registration of legacy shareholders. And that's just shareholders that have been with the company, have free trading shares, can be registered in the prospectus, whatever that is to get to that minimum $15 million. But that is a trend that has continued. We're seeing it. It's alive and well. And I will just point out that in 2021, again, the year of the hockey stick, when any reasonable deal can get done, legacy shareholders were nowhere to be found. So there's some lessons here. When the markets are really good, legacy shareholders unfortunately become less important. When markets are really good, domestic companies seem to dominate and foreign private issuers make up a smaller percentage of deals. When it's inverted, legacy shareholders become really, really important in the process, and foreign private issuers tend to come in and dominate the emerging growth space.
Yeah, I want to talk a little bit more about the foreign private issuers. It's pretty fascinating how many are entering the U.S. markets. What's the data telling us about where these issuers are coming from?
Yeah, well, I'll tell you, that's a great question because, I go to conferences, I talk to a lot of people, we speak to many people in the industry, and everyone always says to us, hey, the Caribbean islands are doing amazing. Cayman Islands, British Virgin Islands, they got all these companies. And I sort of think to myself and say, that's just a structuring technique. Most of these companies, in fact, all of them, I think, aren't really operating out of the Cayman Islands or the British Virgin Islands. That seems to be the structuring jurisdiction for either tax or other operational reasons, especially if you're an Asian-based company. But if you look at the underlying data, like our data desk does, and not just look at country of domicile or maybe where they list the headquarters of the company, but really where the underlying operations of these companies are, you will see they are mainly operating in Greater Asia. A lot of them are coming out of mainland China. Some are out of Hong Kong, Singapore, Indonesia, Malaysia, and other parts of Asia. So the Asian market is alive and well and really dominates that foreign private issuer statistic that we discussed. And again, you have to ask yourself why. Because data is helpful and it's useful, but it's only useful if we can pull apart ideas and trends and other factors that can be used into the future. And one of the things that we've seen is that these foreign companies from Asia and others are a little bit more mature, a little bit more advanced in their business plan. So they may have a stronger balance sheet. They may have a closer path to EBITDA or net income. They may even be break even. But whatever it is, the market, when it gets challenged and all of these average and median prices come down, they seem to gravitate towards the companies that are more substantial. And we've seen those more substantial companies are coming from foreign jurisdictions.
That's great. I want to talk about the uplisting or cross-listing market. Last time we spoke, you mentioned how selective this market was. Is that still the case, and kind of what are you seeing there?
Yeah, I love the uplist market. It's a fascinating market. It was our home market. That's how we really started in the business. It's funny, back in 2020, somebody had gotten me as a present a shirt that said hashtag uplisted. That's how invested in this uplist market we are. We love that market. We've tracked it for years, but it has been challenged. And it really started in the fall of 2022. And there was a pivotal event that happened in the industry. And again, it was related to NASDAQ. NASDAQ made the decision somewhere in the late part of 2022 that they were not going to allow any further the simultaneous reverse split or consolidation and pricing of a uplisted company from either the OTC markets or a foreign jurisdiction, and that the companies were going to have to trade on their home platform or home market for a few days, even after they did the consolidation, even after the capital raise and the listing was ready, just for good measure. That single decision, that risk period of 5 to 10 days of trading, has single-handedly caused the uplist market to shut down in a lot of ways. Now, it's not completely dead. There are deals that are happening. In fact, we tracked on our data desk 4 deals that happened this November, including a whopping $50 million uplist, which is amazing. So that market is coming back as people figure out how to deal with this risk assessment in the 5 to 10 day trading period. Now, I want to say something about NASDAQ. We're big supporters of the regulators. We try to, help create rules and regulations and give advice that make our markets safe and transparent. They had to do what they thought was right to keep this vibrant marketplace available for all of us. So it just was a consequence of the rule change that this market sort of just dried up. But it is coming back as companies get stronger, as they spend more time in the OTC, which sometimes we're a big fan of. Not every company has to go to a senior exchange. As they get stronger, as they carry out their business plan, as they start to execute, this uplist market is coming back. And we expect it to be very vibrant in 2025 because over the last 24 to 30 months, companies have been building, they've been executing, they've been gearing up for this moment. And as the markets get a little bit looser, as capital comes in, as there's more excitement into this market, we think the uplist market will do much better in 2025 than it has done in the previous few years.
I want to dig in a bit more on the regulatory framework which you spoke about. 2024 was also a year full of changes to the regulatory landscape with NASDAQ, NYSE, passing rule changes that can really affect the microcap issuers. Can you speak about some of these changes and maybe about the sentiment, that drives these changes?
Yeah, sure. I mean, this is something we talk about really every day from being in the trenches, and we talk about at conferences, and we talk about to the community and the ecosystem. 2024 has really been defined as the year that tracks 2023, where less is more, with the added benefit of regulatory enhancements and regulatory changes. There's been a ton of them. Some have been legacy driven, like the reverse split rule that we just talked about, where NASDAQ is, very cautiously allowing or disallowing the simultaneous reverse split with pricing. But there's been others. I mean, NASDAQ passed some new rules about affecting reverse splits and coming to terms with how you deal with deficiencies, if you get more time or less time. That has affected the post-IPO market in a big way, which we are a leader in that space for panel hearings and keeping companies listed. There's been of course, the concentration and distribution rules that came out of the NASDAQ pause in 2022 and how deals are qualified at the time of listing. It used to be a long time ago where, and really up until the last few years, where companies had to qualify as the company. Did you meet the listing standards, both quantitatively and qualitatively? Now, we call it the second qualification. You have to not just meet the company qualitative and qualitative standards, but now you have to meet what we call the deal standards. So they're going to look at concentration of the book. They're going to look at distribution issues, who's getting the shares. They're going to do a qualitative analysis to see if this is a transaction that can move forward, even if you have the money raised, even if you're ready to price. NASDAQ is going to put their spin on it, and it's for the better because we want our markets to be safe. And, nobody is perfect. Nobody can predict the future, but I believe what the regulators are doing is an important step to keep our community safe and vibrant. The New York Stock Exchange came out with a new rule in September. There was a huge race to getting deals to be priced because now in the New York Stock Exchange, if you're an emerging growth company, you must raise a minimum of $10 million. Now, that doesn't bode well if the sweet spot is $4 to $8 million. So you can imagine the impact that this rule has had. That is why New York Stock Exchange had 5 issuers in September list on the New York Stock Exchange because everybody was trying to beat or get ahead of this new rule. So that was a pretty major development, in and of itself. And then the other thing is what we've seen, both exchanges, really led by New York Stock Exchange, but also NASDAQ, they're really inquiring and discussing the reverse merger process. New rules came out in July around disclosure items, around SPACs and reverse mergers. But the exchanges themselves are really taking a hard look into these mergers as to what businesses, change of business is going on, both legacy-wise and at the time of the merger. And both exchanges, for the most part, but again, led by the New York Stock Exchange, are evaluating whether the business or the industry that is coming in upon the merger would have been something that they would have approved prior if they were the original business for listing. So fascinating developments. We are, at the forefront of it. We talk to everybody in the industry. We try to, connect with the regulators as much as we can to understand the theories and the development so we can properly advise not just our clients, but the better ecosystem so we can make this market more vibrant and continue to grow and be safe for everybody.
All right. Last time we spoke, we had quite a discussion about the CBOE and them being sort of the third major exchange in the US. Things have not gone well on that front. What are you hearing from the CBOE these days? And also, can we talk about the Texas Stock Exchange that we've been hearing a lot about lately?
Sure. Yeah, boy, did we step in on that one. I mean, we were big supporters of the CBOE, and we still are. I mean, we were very hopeful that they could build a vibrant, emerging growth microcap market. And for whatever reason, it turned out that, they didn't want to do that. They started in the business. They grew a really good pipeline for a year, 18 months, and then they decided from a business perspective that they are going to get out of the emerging growth space. Now, they're still listing companies. They're just going to list larger companies. We are waiting to see the rule change. We haven't seen it yet. We are told something is coming down the pike. So we're going to reserve judgment until we sort of see that. But look, we're big fans of CBOE. We hope that eventually they can find a way to play in the space because more competition for emerging growth companies is better. But I think the entire industry was much more hopeful than it panned out to be. But it is what it is. With respect to Texas, I think there's a lot of enthusiasm around the Texas exchange. We're not exactly sure what it's going to be yet. We've heard reports of, it's going to be focused on the sort of the Southeast, the South, emerging growth space. Then we've heard reports that it's not emerging growth space. The good news is that there will be, hopefully, in 2026, at the end of 2025, another platform for companies to consider. And that's a good thing. As long as there's a platform, there's rules, there's ways to get cleared and give options, we're big fans of that. So we're going to take a wait and see approach on Texas, but we're very bullish. We hope that it comes to fruition. Obviously, we're going to support them. And we'll see what happens. But the reality is NASDAQ is still the 800-pound gorilla. They are the most committed to the microcap and emerging growth space. They do a very phenomenal job of regulating. We don't always agree with them. We obviously have disagreements all the time on deals, but we're big supporters because the hard work that they do and the effort that they put in is what keeps our emerging growth markets moving and safe for all of us, and the ability for companies, entrepreneurs, executives, professional service providers to be able to transact on a daily basis and going forward.
All right. So it's been a tough 3 years, but looking forward, what are your thoughts going into 2025, and what should we expect to see, and anything we should keep an eye out?
Yeah, I'm hesitant to jump into this question because my prediction in 2023 and 2024 didn't really pan out, mainly because of SIBO. But I will tell you this, we can look at the data, what's coming out of the market. We are really connected in the trenches of this industry. We talk to almost every bank in the microcap, weekly. We talk to service providers, consultants, financial people, accountants, companies, CEOs, entrepreneurs. So we have, I think, a pretty good handle on the undercurrent of what is going on. And what we've been seeing since the election, there's been a lot more enthusiasm, a lot more excitement, and a lot more activity to continue with or start up deals that maybe have been taking a wait and see approach prior to the election. So that's giving us confidence that at least the first and second quarter will start to become more robust. We'll see what happens with, pricings and deals and closings, but we are, much more optimistic, at this time right now than we probably were last year this time. So I think it's a good thing that maybe more money is loosening up, coming into the market. Obviously interest rates, global politics, geopolitics, all that affects things. But right now, in our sort of emerging growth world, we're seeing signs of life and exuberance and excitement, and we're optimistic for 2025.
All right. Well, on that note, Joe, thanks so much for joining us today. It's always great to have you with us for these conversations, whether here it's on the Spotlight Series or at one of our panels at our conferences. I'm sure we'll get a chance to connect again soon.
Yeah. Yeah, thank you for having me. I love always talking about everything microcap, everything emerging growth, and certainly IPOs, up listings, and cross listings. So appreciate the discussion.
All right. Thank you. With that, Robert, I'll pass it back to you.
Thanks, Ben. And thank you, Joe, for joining us again. It's always great having you. For anyone who's interested, you can view the materials Joe presented in the description box down below. And if you'd like to learn more about Lucosky Brookman, visit their website at www.luckbro.com. And thank you to all of our viewers for tuning in to another episode of the Lytham Spotlight Series. Make sure you check out our YouTube channel and hit that subscribe button so you're always up to date on the latest content. Thanks for watching.